In today's global economy, offshore companies can offer powerful advantages like tax minimization, asset protection, and enhanced privacy. However, as regulations evolve and scrutiny increases, staying compliant has never been more important. Whether you're a business owner, entrepreneur, or an investor, offshore companies play a legitimate role in international business when managed properly. Hi, I'm Vina White, CEO and Managing Director of WealthSafe, Australia's #1 offshore planning specialist. Today, I'll provide an in-depth guide to offshore companies, their benefits, risks, and most importantly, how to stay compliant every step of the way. So let's get started. An offshore company is a legal business entity registered in a country other than your home country. These entities are often formed in low to zero tax jurisdictions that offer favorable policies, low regulatory burdens, and robust privacy protections, places commonly referred to as offshore financial centers. These companies play a key role in global business operations, enabling business owners to optimize their tax liabilities, protect their assets, and expand internationally. It's important to emphasize that offshore companies, when used correctly, are entirely legal and offer numerous benefits. Now, let's look at 3 ways in which offshore companies differ from onshore companies. 1, location. Offshore companies are set up in jurisdictions outside of the owner's home country or where primary business activities occur. Examples include the British Virgin Islands, Cayman Islands, Hong Kong, and Dubai. 2, taxation. Offshore companies often enjoy low to zero corporate taxes on foreign sourced income, unlike onshore companies, which are subject to higher local taxes. For example, Dubai's free zones offer 0% corporate tax for many businesses, while Hong Kong taxes only local profits at 16.5%, exempting foreign sourced income. 3, regulation. Offshore entities typically face fewer regulatory requirements, focusing on simplicity and flexibility, while onshore companies must comply with more stringent local laws and reporting obligations. So, where are these offshore companies being set up? Some of the most popular countries include Hong Kong, which is a global financial hub with competitive taxes and easy access to the Asian markets. Singapore, which is known for its stable economy, strong legal protections, and business incentives. Dubai, which is a major Middle Eastern hub offering 0% income tax and a variety of free zones catering to different industries. Cayman Islands and the BVI, which are both renowned for privacy protections, tax-neutral environment, and streamlined incorporation processes. There are different types of offshore companies, each designed to meet specific business needs. International business companies, IBCs, are often used for holding assets or engaging in international trade, popular in places like the BVI and Seychelles. Offshore holding companies, they are created to hold shares, IPs, or real estate, often structured to minimize taxes on dividends or capital gains. Offshore trusts and foundations are commonly used for wealth management and estate planning, protecting assets from lawsuits or political risks. Offshore investment funds, such as hedge funds or mutual funds, are often established in tax-neutral jurisdictions like the Cayman Islands to attract global investors. Offshore companies aren't just for large corporations. They are used by entrepreneurs to optimize tax liabilities and expand into new markets, investors for asset protection against legal claims or political stability, multinational corporations to simplify cross-border trade and to minimize operational costs, high net worth individuals for wealth management and financial privacy. Even small and medium-sized enterprises can benefit by streamlining international operations and accessing global markets. Now, let's discuss the primary reasons why business owners and individuals choose to set up offshore companies. 1, tax minimization. Offshore jurisdictions often offer low to zero corporate taxes on foreign earned income. For example, Dubai's free zones offer 0% corporate tax for businesses with profits under 375,000 AED, and those earning above that amount are just taxed at 9%. And Hong Kong exempts foreign sourced income from taxation. But it's crucial to ensure you comply with the tax regulations of your home country. 2. Asset protection. Offshore companies provide a legal layer of protection against lawsuits, creditors, or political instability. Trusts and foundations in places like the Cayman Islands or BVI help safeguard wealth. 3. Financial privacy. Offshore jurisdictions often offer strict privacy measures, limiting public access to company ownership information. For instance, the Cayman Islands and BVI are known for their confidentiality protections with no public registry of beneficial owners. 4. Ease of international operations. Offshore companies simplify cross-border trade, benefiting from favorable tax systems and fewer regulatory burdens. Singapore and Hong Kong are prime examples of jurisdictions that offer excellent banking services and support international trade. 5. Estate and wealth planning. Offshore trusts and foundations can play a vital role in managing wealth across generations, reducing estate taxes and safeguarding assets from legal disputes. But with great benefits come great responsibilities. So to avoid fines, penalties, or reputational damage, offshore companies must remain compliant with both local and international laws. Let's explore the key compliance considerations. Incorporation and registration requirements. Each jurisdiction has its own specific incorporation rules, like capital requirements and the need for local agents. For instance, companies registered in the BVI must appoint a registered agent, and Dubai might require more extensive documentation for certain industry. AML KYC compliance. Offshore entities are subject to anti-money laundering and know your customer regulations, which aims at preventing illegal activities. Countries like Hong Kong and Singapore do require that offshore companies verify the identities of the shareholders and directors. Annual reporting and auditing obligations. While some offshore countries have relaxed reporting requirements, others like Hong Kong require annual audits. In contrast, Dubai's free zones offer more lenient reporting, but companies must still comply with industry standard specific certifications. Tax reporting. Offshore companies need to navigate both local tax laws and international tax agreements to avoid double taxation. For example, Singapore has double taxation agreements, DTAs, that prevent businesses from being taxed twice on the same income. Meanwhile, countries like the UK and the US require residents to report offshore income to avoid penalties. Compliance with CRS and FATCA. The OECD's Common Reporting Standard requires jurisdictions to exchange financial information, ensuring offshore companies disclose financial data to tax authorities. The US has similar requirements under FATCA, which obligates American citizens to report foreign-held assets. The regulatory landscape surrounding offshore companies has changed drastically over recent years. International cooperation between tax authorities is at an all-time high, thanks to frameworks like CRS and FATCA. Additionally, the OECD's Base Erosion and Profit Shifting Initiative targets tax avoidance strategies used by multinational corporations to shift profits to low-tax jurisdictions. Countries now have to ensure that offshore companies meet international standards for transparency and economic substance. This means that simply having a paper presence in a jurisdiction is no longer enough. You need to actually have business operations in that country to qualify for tax benefits. As we move forward, offshore companies will face increasing pressure to maintain transparency and meet stricter regulatory standards. Expect to see more rigorous reporting requirements, higher penalties for non-compliance, and a global shift towards financial transparency. Businesses that fail to adapt will face significant risks, from losing access to banking services to potentially being blacklisted. The key takeaway: compliance isn't optional. Offshore companies need to build transparency into their business models and continuously monitor regulatory changes to stay ahead. Offshore companies are incredibly valuable tools for business owners, entrepreneurs, and high net worth individuals. They offer strategic advantages from tax minimization to asset protection and ease of international operations. However, the evolving regulatory landscape means that these benefits can only be enjoyed through careful planning and strict compliance. So if you're considering setting up an offshore company, expert guidance is essential. WealthSafe is here to help you navigate the complexities from selecting the right jurisdiction to managing ongoing compliance. So don't leave your global business strategy to chance. Thanks for watching. If you're ready to start your offshore journey with confidence, schedule a 30-minute complete wealth control tax strategy consultation with one of our specialists here at WealthSafe. Our team will ensure your offshore strategy aligns with your business goals while keeping you compliant every step of the way. Like, subscribe, and hit the bell for more insights on global business strategies. See you next time.